Good morning, everybody. Welcome to the Flow Show. I've got a new game for you guys and girls this morning. It's I've been playing. How many times can I look at my screen and see euro dollar trading 107.70? And I'm up to 89 times since yesterday afternoon. It's a great game, I can assure you. Kay, want to play, mate?
I've been playing that game for days in the room already. It's a real magnet, this 107.70. It's in the middle of where we should watch the rate, right? That's exactly that. Yeah, it's a real magnet, and it's probably it will be the most actively traded rate for the past week.
Yeah, and let's see if US CPI can kick it away from this number at least for longer than 5 minutes, and we'll talk about that in a bit.
Not, if that CPI can't kick it away from that level, then we better go and sell umbrellas in the desert.
Yeah, exactly. Yeah, don't sell them here; they're all sold out. Anyway, right, let's see what's going on. Let's start with a bit of data today over in Japan. PPI data coming out a little bit hotter than expected by a pip, 0.2% versus 0.1 expected. Matches the prior, though that was a higher revision. Month-on-month number, though, coming in flat versus 0.1 expected. More bad news in the machine tool orders. The year-on-year numbers there for January coming in at minus 14.1 versus 9.6 prior. Again, that was a higher revision, hence why it's that number's green. Not looking good in that there. Let's have a quick look, see what it's been doing. It hasn't been doing well for a while, if I recall. Yeah, it's been pretty negative for a while, but as you can see, it does tend to have a bit of trends when it moves one way or another. But that'll be factoring into the economic picture going on in Japan. As we know, the big focus is on wages. Over in New Zealand, a couple of pieces going out. Many saying that the RBNZ could be heading for a policy mistake if they decide to hike rates. A couple of banks pointing that out. OIS markets, that's overnight index swaps, pricing about a 50% chance that they will lift the cash rate by 25 pips to 5.75% in the first half of this year. And then one of the banks saying that they will undo any such hike, this is Nomura, by August. Then they will lower costs into the final meeting of the year by another 25 pips. So they see 50 pips of cuts after they've hiked, or if they hike to 5.75%. What do you make of that lot, Kay?
That's ANZ responsibility. That's not the RBNZ responsibility. ANZ was the one coming in, calling for 2 more hikes by the RBNZ on the last numbers. I'm not sure that OR ever told us that they were going to hike rates, or at least not in so many words. I think that's the banks trying to point at the RBNZ, where it's the banks making that call. So
ANZ on one side, Nomura on the other.
With those calls, that's for sure. I still think no more hikes. That's what I view. That's unchanged. But it is a bit of a conundrum is not the right word that I'm going to look, but it is a bit strange that those numbers are so volatile over there, right? Of course, it's not a big country. It can be volatile, those numbers, but that's quite a move down. But of course, again, it's expectations, right? So we have to wait for the real numbers to hit the wires. But we have seen that on that ANZ call, the last week, was it right? Kiwi went up over 1%, and now it's giving back 2/3 of it, and we're back to square US CPI, I guess, and that's it. I was surprised last week about the market reacting so much to that ANZ call, by the way. Because I haven't seen in OR's comments or RBNZ comments that they were keeping all options open, but that it's it's the data that then spurred the NZ to say like, oh, they are going to hike twice, because then not only once but twice they were supposed to hike, and I really didn't follow that that path anyway myself. So now those people saying they could make a policy mistake, yeah, they could make a policy mistake if they would do it, but will they do it? Not my base case personally, to be honest.
Yeah, exactly. But again, it just shows you how the market can flip on these expectations. And you know, when you're trading something, particularly against the dollar, you know, the dollar's always going to weigh out. It's a similar theme to what I'm looking for cable this week. You know, if it's good UK data, but that's matched with good US data, the dollar's going to win out. So that's why I'm potentially looking at, or I'm leaning towards selling the decent rallies in cable should we get one, which it's on its way a bit this morning. But we'll get to that in a moment. We've also got comments from RBA's economist Kohler saying that inflation is going down but still too high, and that it will take some time for inflation to get back within the 2 to 3% target range, and then expecting it to return to target range in 2025 and the midpoint in 2026. Riksbank's Janssen says that it's improbable that there won't be pauses in the cutting cycle when it happens, as it kicks off. It seems the timing of major central bank cuts will be fairly similar. Again, what we've been speaking about here, that they're all looking and likely to potentially go all at the same time, keep the balance in play among central banks. Anyone would think it's a big conspiracy, but who knows? Swiss CPI, Kay, I know this has finally got you 88 in dollar Swiss.
Yeah, that is a surprising read, because for two reasons, actually. First of all, because Jordan himself said that there was a risk for a higher print. And traditionally, the start of the year in over there also sees a bit of a higher print. So we could argue that this is a double negative. Not only is the CPI lower, but it's against what the norm would be as well. And then in particular, and we've been talking about that with Magix in our flow room. In particular, we've seen the impact of that stronger Swiss in the important inflation numbers, which have gone deeply negative to minus 0.9% or so year on year. So that is the impact, and that is also where we come back to what Jordan was saying, that it starts to perhaps hurt a little bit on the Swiss companies front, because of course we know that they are big exporters of chocolate amongst other Rolexes and things. So this all plays into that bigger picture that I've been talking about, that it's probably enough for the Swiss franc and that we are on our way to correct this especially second half of last year, very strong Swiss franc. So this confirms it. We are on our way, but then again, we need to keep a bit of a cool head in this, right? Compared to averages, we are still, and when I look at the rates, I will show this. We are still like around August levels, around May levels in stuff like the dollar Swiss, for instance. So we corrected kind of the end of the year, but we have not yet started to reverse. Okay, this is we have not yet started to reverse. And what happens here? And you can show it too. Look at that 88.20 in the dollar Swiss. Look at that level. It is really the magic level for me. I've been saying that many times. This is really the magic levels. High today, 88.18, and I mean, a picture in this case says more than 1,000 words. This is really going to have to break, and will we get it over the US CPI? Well, that remains to be seen, of course. But in the meantime, we look at Swiss crosses, and they have now really started to adjust. I've seen also on the flows that hedge funds have started to switch from long Swiss into short Swiss, but the numbers are still very, very small. I mean, there is massive room to increase those positions, and I would expect process is one thing, but then if you look at the dollar Swiss, yeah, sterling Swiss is one as well. Of course, today on the back of those that let's call it a double whammy, sterling Swiss really was shooting higher. But again, we have to keep a cool head, because if you look at as well, from the end of the year, we corrected about 5% in the dollar Swiss. Okay, so Jordan as well said one line. He hopes that the market is not going to undo all their good work. So we really need to not get overly excited. I think we can get a little bit excited because Swiss is weakening, and a lot of us in the rooms are short Swiss, but we should really keep a cool head, because Jordan can come out one day or the other and say like, hey, you guys are pricing rate cuts for March. We're not there, okay? And they may also say like, hang on a minute here. You aren't doing all our good work, so they can call a halt to this whenever they want as well. But in the meantime, fundamentals, pricing, price action is favorable for a little bit more Swiss weakness, I guess.
Yeah, I mean, we're not really going to get anyone pricing cuts in Switzerland, are we? I mean, they never got their rates up anywhere close to everyone
No, but
else.
we are well above inflation now, and you look at the real rates compared to where inflation is now. It's I think it's limit border for March, but we have to know that our S&P only meets once every quarter, right? So and
Yeah.
for
So
now, they never hinted at doing anything intra-meeting. So in inter-meeting, sorry. So if they don't do anything in March, there's another 3 months, and then they are going to likely fall behind the rest of, like for ECB, for instance. So voices are mounting that they could be tempted to do something before the rest. So we are looking then at March, but that's I think really a dime on its how do you say it? A dime on its side, or
yeah, flip of a coin.
yeah, that's it. Yeah, I think that coin can drop any side right now.
But with this one, it's a question of scale. I mean, as you can see there, CPI in Switzerland didn't get up to the lofty heights that we saw everywhere else. 8, 9, 10%. So that's why the bank rate never got up as high as everyone else as well. So we're playing with small margins here, but they'll be worried about inflation dropping negative again, which will bring rates down. But what's their neutral level? Would you think, Kay? 1%?
Yeah, somewhere in the 1.5. Somewhere I mean it's that's a lot of guesswork, right? But I think call it somewhere 1.5 to 2. So they won't cut much. I won't think so. Because if we assume, and the big assumptions are that way right now, then inflation is not going to drop back to zero anywhere. And assuming that we are like going to stick around this 1.5%, I think it's an opportunity for central banks now to keep at least some sort of positive real rates in the market too, because it's not too bad for investors, right? If you start to look at negative rates, investors are fleeing your currency. Now, on the other hand, the other thing as well is that Swiss franc is not also one of the major investment currencies, right? It comes well behind stuff like sterling and yen. So you have to put everything in context all the time. But I do think that they're at 2.5, I think, right? Are they 2.5 or a 3? I don't recall.
No, it's less. It's less than that, isn't it?
No. Let me just
Remember.
check quickly. But anyway, they are not going to Oh no, they're only at 1 3/4.
Yeah, 1 3/4. That's what I mean. Yeah, there's not much to cut there.
No, there's not much to cut. No, absolutely no. I think a quarter point, but it may be just, you know, the fact of them cutting. And you know, it's not the only thing which was behind my thinking that Swiss should weaken. It just had strengthened too much. And we were also talking a lot of times about their the level of their FX reserves, which they used to bring the Swiss up very, very strongly. Swiss has really been you're talking about more than 10% on Euro Swiss, for instance. You're talking about more than 10% on the dollar Swiss. That is their doing.
Yeah.
Regardless whether the dollar or the euro was rising elsewhere, they were hammering it. It all started around, even if I recall, yeah, it all started around, around that 101 level, just above parity. That's where they said, here we, no, yeah, there on the 101, and then that's where they said, now we are going to combat inflation by buying Swiss franc, and they did exactly that. But then when you stop doing it, you always have like a kickback, right, to what they do, and the fact that they themselves said that Swiss franc has strengthened a bit beyond their own points of measurement where it should be. So I think we're just correcting, and now we will see how much further it has to go. I think it has a bit further to go. But again, we need to keep a cool head, because any day they could come out and say like that's enough now.
Yeah. So just a bit of context, if you like, for people who are trading this, who don't know the full ins and outs. You're not so much trade. This one isn't going to move so much on central bank movements. You know, it's not like the Fed, where the market's expecting 150 pip of cuts this year. You know, you might get 25 out of the SNB at most. So this isn't so much a monetary policy trade, but more a trade on what they did in the currency itself rather than with rates. If you get my drift, but is that a fair assumption?
Yeah, and there's also the other consideration. Is SNB going to be okay with the Swiss franc being a safe haven again when other economies start to turn down? I'm not saying that we're going to have like a deep recession, because it's soft landing all over the place. But if they're okay with Swiss being a bit of a safe haven again, so keeping the Swiss franc a bit stronger in case of risk off, how people call it, then they will keep the rates relatively stable. If they say that, well, if now the market is starting to buy Swiss again as a safe haven, but we don't really like it because of our exporters and our major companies, then they may be tempted actually to cut rates deeper, because they want to, how should I say, demoralize investors to use Swiss franc, as we know for years and years it has been the case, as a parking place to put money. Yeah. And if you continue to pay those people to put money in there, you're going to attract funds again. So, but that's all considerations in that run in the background. I don't think that's on the forefront of the minds right now. But those may be things that impact how much they would cut or not. Yeah.
So long story short, folks, the Swiss franc is one of the most manipulated currencies in the world. So you can trade the techs and enjoy it and enjoy the moves, but be ready that if Mr. Jordan wants to come and kick you around the chops, he will do just that. So it's funny how every different currency has its own life and story behind it, and that's what
makes our job so interesting, right?
Exactly.
You can look at stuff, and that's what I always say. Like, and I don't want to discourage people for watching it, but I haven't watched Dixie for 40 years, and I won't start to watch it, because I've got much more interest in the individual currencies than just an index, you know.
Yeah, exactly. Anyway, before we get stuck into the wrongs of the Dixie, let's move on quickly. Right, looking at coming over to the UK, looking at that data, the jobs data, which has still got a bit of a shadow hanging over it. while the ONS decide how they're going to add this all up and calculate it and whatever. So, but as I said yesterday, you have to take the numbers, and the market takes numbers for what they are when they get printed. Claimant count a bit lower than expectations. So this is the amount of people claiming for being out of work and the like. The unemployment rate dropped down to 3.8%. Again, there's probably some reworking in this as well. We did have that report revisions and stuff that brought the unemployment rate down as well. So that's probably mixed in with that. Employment change there, the 3-month rolling number, roundabout expectations and prior. Wages, they came down as expected, but not as much as expected. So keeps it in the sticky category, hence why one of the reasons why the pound is looking a bit more positive this morning. Overall, good data, which certainly dismisses the negativity that we can get from those in the UK. Bailey was tipping that as well in a speech yesterday, saying I wouldn't put too much weight on whether the UK enters a technical recession, which is possible by the expected numbers for GDP coming out later this week. Says any recession will be shallow, and we are beginning to see signs of an upturn. So, you know, we're in trouble if Bailey's turning bullish on the economy. Things aren't looking as bullish. Well, they are and they aren't. The German zoo data, current conditions falling back even more, down 81.7, so worse than expected, and the prior month. However, expectations still continue to pick up. So the firms in Germany, they see problems now. It's not looking good now, but they're getting a bit more bullish for the future. We'll see whether that translates into reality. The Eurozone zoo as well, also improving 25 from 20 expected, 20.1 expected, but not many people pay attention to that one. Over at the ECB BODs, ECB's Cipollone says there's no need for monetary policy to generate further slack to keep inflation in check with demand. Inflation expectations are well anchored. ECB's Wunsch says the risks are not big either way for rate cuts, whether we wait for more data or not. So slightly dovish slant there, saying that you know, they don't need to wait for more data, hard data, to tell them what the trends are looking like anyway. ECB's Butch, and this is the head of the Claudia Butch, the head of the the head of the ECB supervision thingamajig, whatever they call it, supervising department, not a governing council member, but she said Eurozone banks are unprepared for some of the new economic and political risks they face. We've obviously had the guard weighing on the Trump potential presidency campaign, and we also know that some of the economic problems could revolve around real estate, commercial real estate. So that's the head of the supervisory board there, just warning on that one. Over in the US, Fed's Bowman says it's too soon to project when and how much the Fed will cut rates. Don't see cuts as appropriate in this immediate future. Says current Fed policy rate is in the right place, but many risks remain for the Fed's inflation fight. That inflation fight got a bit of good news from the New York Fed inflation survey, expectations survey. 1-year inflation dropped a pip to 3% from 3.01. I'm not sure if it's in this calendar. I know Brent's going to ask me. Is it on here? Nope. No, so you have to take my numbers. 3-year expectations did fall 2 pips to 2.4% from 2.6. That's the lowest since March 2020. 5-year inflation expectations were unchanged at 2.5%. So expectations are a big part of central bank thinking, and those numbers are coming down, although still a bit sticky. Right. Soft landings, no landings, crash landings. According to the latest Bank of America data, global investors are apparently at their most bullish in 2 years and no longer expect a recession. They say this is the first time since April 2022 that fund managers have dropped their calls for seeing recessions. And they've also cut their cash holdings to 4.2% from 4.8%, and they've lifted their global stock allocations to a 2-year high. So that's again, we've been talking about that cash waiting in the wings, looks to be going to work, and that's been one of the reasons why stocks have been so well supportive. If investors don't think there's going to be recessions coming, or if they are, they're going to be shallow and quick, then they're going to start putting some of that cash to work, and reallocating between the different assets. So that's a bit of a boon potentially for stocks. What do you think about that, Kay? And this asset move, have they finally? Is it finally time to think about recessions now that these guys are seeing no recessions?
It's always the case, right? Before every big downturn, people are the most bullish, and nothing can go wrong. But hey, we have to look at the data. The data aren't bad. The data aren't falling out of bed, and inflation coming down a bit with the rest of the numbers still printing really good. Every number is debatable, we know that, but the numbers are still holding up. It's those people need to put their money to work. That's what we've been saying. That's also one of the reasons why, even though, for instance, Japanese investors are holding back from buying JGBs until the Bank of Japan has risen the rates. They were holding back last year as well. They were even selling US Treasuries at one stage, but now they have to get back, even would it be for a few months or so, because they need to show returns. If you keep your money in your pocket, you're going to make zero, right? So that's the thing. That, I mean, cash, is an option in a recessionary market where the returns elsewhere are negative, but when it's like this, you need to put your money to work. That there is no alternative. They have to do it, right? But are we at the peak now? Now that they all see that they are diving into it, who will tell? I don't know. But for the time being, the data that I see, they are late to get back into the game, but the game doesn't seem to be over. So, and that's why we've been banging on the fact that we are all data dependent. Well, the data show us that the party is not over yet.
Yeah, exactly. And we've noted that there has been reallocation. A lot of people, a lot of money moved into bonds when you're yielding 4 or 5%. There's plenty for investors to lock into that for a period. It's all about your risk allocation as well, how risky you want to go. But yeah, it does play into this stock rally that we're seeing, that money is now coming from the sidelines into it, and probably doing a bit of chasing. So that could lead to very choppy times ahead for stock markets. We had the Nikkei tapping 38,000 this morning as well. So that's one to keep an eye on. Always good for a bit of watching. And
the thing is as well, if you look at it, in end of October, November, people were taking 5% on the 10-year, and all good and dandy. And a lot of money managers, they were very right in doing so, because they manage money in just via treasuries and stuff like that. But then if you look at others, other money managers, asset managers, hedge funds, they're competing with each other for clients. And then you see the just to name the S&P rallying from 4,100 to 5,000 in the space of 3 months. That is, if my calculations are correct, something like 23%. Your 5% that you get on your treasuries just disappear in a big gaping hole. So they say like, whoa, if we're only going to give 5% to our investors minus cost, they will like go elsewhere. People who have taken a part of this rally in the S&P. So, and it's all playing in favor of attracting more money into stocks right now, because this is just the way the market functions, right?
Yeah, exactly. I mean, S&P's one losing week since 30th of October. One losing week in the whole of that period. I don't think it's had. I'd have to check back. I don't think it's had even that much of a strong record going all the way back in the years from when the rally started. So yeah, this is it.
You can't have the. I mean, the pandemic was a bit of a different issue, but there's still a lot more money in the system now than pre-pandemic. So that is another one that pushes in the back of those equity markets.
Yeah, and this is supposed to become an environment of lower economic activity, potential recessions, and lower rates. And here we go, stocks still pushing to all-time highs. So yeah, it just shows you how crazy this market is, really. Right, while we're talking about stocks and companies, Mr. Musk is feeling generous because apparently Tesla are slashing prices for its Model Y cars in the US by $1,000. Not a big deal, whatever they are. He's cutting it from something like 47 grand to 46 grand, so not a big deal in the scheme of things. But this is a bit like the jobs thing that we've been pointing out for several months now, when you get these little comments crossing the screen. Okay, the headlines have printed it as slashing prices. Okay, he hasn't slashed prices, he's just knocked $1,000 off until the end of February. It's a little discount. But this is what you want to look out for in a deflationary world, and when there's trouble brewing for an economy. If you start seeing lots of big firms starting to cut prices here and there and whatever, it can start off small, a bit like the jobs numbers, where it's only a few hundred here and a few hundred there, and then it becomes more widespread, and then the discounts get bigger and they last longer. That's early signals of problems coming. Just the same theme as the jobs market. You listen to the headlines, you pick up, oh, we've had one headline, or now we've got two headlines, now we've got 5 headlines, now we've got 10 headlines.
Where did they cut prices?
In the US.
Okay, but because I see a headline that they raises the price of their Model Y vehicles in Germany.
There you go. Yeah, good. Unlike Germany.
I think a lot has to do with the competition as well. I mean, there's a bit of a big wave of these. What is it? BYD or so? The Chinese ones washing over
there's a few of them.
over the market.
Yeah, there is trouble in the EV world. It's not taking off as quick as a lot of manufacturers are looking for. We had who was it? Bosch, was it, cutting their auto driving unit jobs there because the AI and auto driving isn't where they expected it to be by now. So yeah, the EV market's a bit of a thing. But yeah, it seems like Musk has got it the wrong way around. The US economy is doing well, so you'd think he'd want to put prices up there, and German economy is not doing well, so cut prices there. But who knows what goes on inside Elon Musk's head from day to day? Certainly not.
Probably had a bit of a party.
Yeah, exactly.
Right.
A bit of that's the one, Gavin. It was in software development. That was in their auto driving unit. Getting cars to drive themselves. They're a bit behind in where they wanted to be. Right. Potential geopolitical news here. The EU has apparently put forward some new trade restrictions, which are targeting around about 24 companies. These include 1 from India and 3 from China. That could be news from the China front. These trade restrictions are because of these countries and firms' backing of Russia in the war with Ukraine. Why it's important between EU and China is this is the first time the EU will be imposing sanctions on mainland Chinese companies. So expect a response from China on that one. Again, it plays into the fact that relations between China and the West are still not looking good, and that's not going to be good for their economy either. So just one to keep an eye and see how that doubles away. Note how they drop that news while China's on holiday, but they will be watching. They're always watching. Let it be known. Right, let's have a look what's going on. I might as well stick with... sorry, Kane, have you got anything else that's come across your screen?
No, we've been talking about something in our room, but it's like an ultra long-term thing about the the Japanese size of the economy, but it's something it would take us too long to discuss about those things in here. So no, move on, mate. US CPI coming up.
Yeah, exactly. Which we'll look at in a moment. But yeah, just want to start with the S&P while we're in it. A lot of squawkers coming out, a lot of talkers coming out, top callers. They've been trying to call a top since 48, and they've been wrong all the way for another 250 pips. We've had this little bit of a move off the top from yesterday. It dropped, some 38 pips or so, and that got all the top callers coming out and squawking about it. Is this a top? Who knows? I don't know. You don't know. No one knows. The only way we'll know is if we go back there, test it and hold it. Then we'll have reason to believe it's a top, or we start breaking through some of the support levels. That's when we'll know. So I know there's a few people out there who are like, where's the top? Where's the top? Where's the top? Well, you have to wait for the price to tell you where the top is. So at the moment, 5K is the big number. That was the break point. We had resistance there for a while. Then we broke. Then we held it right after. So that tells you everything you need to know about this level. If we get under there, then maybe we're going to start moving down a bit as well. I wouldn't rule it out, the fact that we moved down. And obviously the data could be a bit of a kicker for this one. When we had the 49 break, we got a trend refresh there. We had a move back through. Came back under 49, then we moved back up. This is what you want to see in a trend, and I've shown this picture before. You get a rally, you get a pullback. You get a rally, you get a pullback. The pullbacks have been shallow or non-existent after this one, so it's potentially setting up for a pullback. How deep it goes, who knows? If all that money is waiting in the wings, if they get something under 5K. Maybe down around here, 49.85, 49.60s, maybe even down towards the low 49s. Then maybe some of that patient money will start coming in and picking it up. But as for top callers, well, they can keep calling tops. If they keep calling it often enough, they'll be right one day in the end. But for now, if you are looking to short this, you know where your pain level is. Your pain level at the moment is 50.51. If you even make a high 50.52, 50.55, and then drop down, that will tell me that this move is continuing, because we're prepared to break those highs. But if we get another move up here, I should think, if we get a bounce from here, it hits somewhere like this 50.30, maybe 50.40s, 50.37s, and it holds there, that will tell you that there's some protection coming off the sellers from these highs. And then, I've pointed out in pairs like Aussie dollar, but on the other way. So, it's almost like forming, dare I say, a head and shoulders type effect. Come up high, break the high, come back under, can't break the high again. So that's your first indication. If we're making a top, holding around there on a bounce. Second would be holding the high on a bounce. If we do that, maybe we're getting something a bit more significant in terms of tops. Or, as I say, on the other side, we start breaking down some of these support levels. Then you'd be more inclined to say there's a top up here. But as I say, the CPI is to come, so that will be the kicker for it. So what's due from the CPI today? CPI expected to keep coming down. Headline CPI dropping back to 2.9%. You will remember this was a little bit of a blip move, and we've had a couple of these blip moves coming in. Well, if I get in a bit closer, let's go into that one. So we're all coming down nicely. We had a bit of a blip late last year. We had a little bit of bounce, then we came off, then we had a little bit bounce last month. So we expected to come back down to 2.9%. But this to me is looking like it might be a case of inflation potentially settling into a bit of a range here. It's stopping the drop. And now we're doing a bit of sideways action, which has been one of my fears throughout this whole thing. It's okay, inflation pulling back, but where does it pull back to and where does it hold? And that's the key for central banks. If it continues coming down to target, all well and good. But if it starts staying sticky, then that's going to mean that rates stay higher for longer. And if the economy heats up, they may even need to switch to a more hawkish tone and think about further hikes. So we're not out the woods yet, but for today's numbers, If it's less than expected on either metric, then that's going to take some of the hawkish heat out and probably get the market pricing in May cuts once again, or increasing calls for May cuts, expectations there. If it's above expectations, anywhere close to the prior number, then the dollar's probably going to rip, and more of those cut forecasts or estimations are going to get drawn out of the market for May and likely pumped more into June, July. Kay, what are you expecting for this one? Are we going to see softer numbers? Are we back on track, or are we staying sticky?
That's always the big question. Look, I'm going to go with the majority of the forecasters who say that it's going to come out sort of in line. I saw, who was it, Goldman, thinking that we are going to be just that little bit stickier. Instead of 2.9, we won't get a print in the twos, and the headline printing at 3.01 or something, and the core still 3.8. But I don't know. I think it's more. Yeah, it's gonna. I've seen a lot of people also trying to say that we are going to have to look at what the services index does outside of energy for seeing if there's a trend there. It may be a bit of a complicated one to trade, but I mean, to keep it really, really simple, if it comes higher than expected, the market we are in this repricing period still, and if it comes in higher than expected, it's just going to take those US yields, US 10s through 420, US 2s through 450, and that's going to be your pancake day rally in the dollar. Yeah, for those who don't know, it's Pancake Day in the UK. So we are actually not only looking at the US CPI, but we are going to have some nice pancakes today.
Yeah.
But yeah, I think and there's it can really. I'm very, very light in dollar exposure. I have options. I have long dollar options, but I'm very, very light because this market is can flip on a dime here, and we are extremely stable in that euro dollar, as we've already been talking about, and it's about time we break those ranges now. I think if it's sticky, euro dollar is probably going to break 107.15.25, dollar yen break 150 again, and you name it, dollar Swiss breaking that 88.20. It looks as if we are getting ready to do that, but it's going to be equally get a surprise to the downside. I think it may have a bigger effect than to the top side as well.
Yeah, but
I'm really in between two chairs here.
Yeah, I'm the same. I'm thinking that the dollar selling on soft inflation is beginning to ease because it's now a trade-off between inflation coming down and the economy remaining strong. So it's not such a negative or not such a dovish, bearish move that inflation's coming down now as it was before. You know, when inflation was coming down, everyone was getting cut excited. Well, now we've got this soft landing. So inflation coming down is actually a good thing if the economy is still ticking along nicely. So yeah, I think that the selling on soft inflation aspect is waning. I think perhaps, but we'll see what the data does and what the market does. You know, we can all guess it, but the market's going to do what the market's going to do, and we'll go with it and adjust with it. But yeah, so I think if you get a sell off in the dollar, particularly maybe something like euro dollar, where euro dollar starts rallying on soft inflation data from the US, I think again that might be something to look at for a fade, a bit like I'm looking at cable, because we're going to switch back to the hard data, retail sales from the US and the like, and if that's still solid, then the dollar's going to rally again. So I think I'm in the same boat as you. I'm still a bit more keen to sell rallies versus the dollar than buy dips in the likes of euro dollar.
And again, choose your dollar wisely.
Yeah,
Of course, tomorrow we are going to have those sterling CPI data, which are also going to be a big mover. Now we've had the a part of the labor report, but cable I would perhaps not counter trade it as eagerly as I would for stuff like euro dollar, maybe dollar yen, dollar Swiss. But I'll gladly leave whatever outcome. I'll gladly leave the commodity currencies alone, unless Aussie dollar starts to break 64 three quarters, Kiwi dollar starting to break 60, 80, 90 again. But yeah, counter trading dollar weakness is going. Yeah, and I still like that idea as well. But we will see. But if it's a sticky one, then I think that's going to be your leg, your leg to really break a few levels, I think.
yeah, yeah. I think if it's sticky inflation, then I definitely think we get a test of 107 today. If it's particularly sticky, particularly in euro dollar.
Yeah,
So yeah,
but if you get a weaker one, Ryan, but I mean it's the same with all data. A weaker one should be something like the headline 2.7, 2.8. Not like 2, because everybody is going to wonder what on earth has hit the US.
yeah,
But if you get a mildly weaker one, then your S&P is going to fly again.
yeah. Well, that'd be nice. Well, we shall wait and see. We shall wait and see. Here's one that's finally tapping the level. Oh no, wrong one. There we go. Euro sterling. That data this morning put in a bid in the quid, and it's forced it through this, I've called it 1525 area, 20 area that we've been sitting on for a couple of weeks now. We're testing it. We're testing the big figure. But as I've been saying, this is a difficult one because it's coming amid all the data. So we get more strong numbers from the UK tomorrow. If CPI is sticky tomorrow in the UK, this one could be breaking this zone. But I want to know where it closes. I know I sound like a broken record, but it is fundamentally important to me where it closes. We get the CPI, it could trade all the way down to 84.5 on a really sticky number. But if it can't stay there and we go back above 85, that's going to say something different. So for me, I've still got my little chip on the table from when we were last down here. If I get stopped out, okay, no harm. I'll give away 25, 30 odd pips on the small piece I've got left. So I'm not gonna cry over that. I am tempted to have a little nibble down here. I was bid 05 previously, but with the data risk, I don't know. I might just sit back and let it do its thing. I'm not going to be scared to miss a trade. I'm never scared to miss a trade. There's always plenty of opportunities. But here we are on the big figure. So it is an important moment. Will it survive through to tomorrow's UK data or not? Again, that will tell its own story. Have you got anything on this one? Are you still a bit short?
I'm a bit short again. I'm a bit long sterling Swiss, but again, I'm more than happy to take some off, which I already did actually in euro sterling, because remember last time we were in this area around 85. We had that weak European data sending it through 85, and then the next an hour later, I think we had or half an hour later, we had a weaker UK data, which which completely reversed it. So we've always got to bear in mind that we have the next set of data upcoming tomorrow, which with what the BOE is trying to figure out, could be actually a bigger set of data than the one that we saw this morning.
Yeah, very much so.
And you can have like the same thing is that you test it, you go below, do a few stops, and then you go massively the other way around. And that's why I'm really not going to hold too much sterling into tomorrow's CPI. I think we may see a quick move below there, the prior low, and then stabilize around 85 perhaps. I don't know, it could go for the break, but people still like to buy sterling in a way. Me too, but then tomorrow can change a lot.
Yeah, I mean, it certainly doesn't change. It doesn't change the trend that we've seen, particularly for the year. The trend's been pretty evident. It's been sold all the way. We keep making new lows. The highs are coming lower as well. But it is you can't pick it. UK CPI could be sticky, and everyone buys the quid and sends it through 85. GDP on Thursday could come in much better as well, and then that goes further. Then retail sales could collapse on Friday, and we're all the way back up again. So it's very difficult when you get moments like this, especially with data, day after day after day. And there's not much Eurozone data in reply. So there's not much for the euro to grasp this week. We've got GDP flash and industrial production, but this is Q4 stuff, and we're going to be arguing over half a pip here or there probably. So it's not going to be probably a huge mover for the euro. But it could create that divergence between the Eurozone and UK on the economic front as well. But yeah, an interesting one. I'm just going to watch it for now, as opposed to trade it, except to manage what I've got on at the moment. Right, what else is going on? Not a lot elsewhere. Dollar yen still creeping about. We're back. Or I will say we're back. We're into 149s, looking at those highs again. We have nicked above the highs. What's going on with this one, mate? I haven't really got much of an interest in it at the moment, from a trade point. I think looking what happens, whether we get a test of 150 is obviously going to be important. But we've had this little break above this 148.80s area. We're holding it. Is it going to push on, or are we just sitting and waiting for the BOJ?
Well, waiting for the US CPI. Get through. If CPI is sticky, this is probably going to fly. If you go back to November, you see the high there, 149.75. Tried it 3-4 times. November, just a little way back. Yeah, there you are. There's those ones, 3-4 attempts, and before the dollar yen really went down for the year end, and that's where the level is right now. 150 psychological, of course. If CPI is sticky, it's probably going to fly through those levels. And 148.70-80, and that's your goalposts. If CPI comes in as expected, I wouldn't be surprised that some people try to sell the dollar at first, but then it's going to be countered again. So those are my two levels. I was a bit long up to this morning. I've actually lobbed them out on the move back from those highs, and I'm just waiting without a position. But I'm more ready to reload longs than I would be hitting the dollar on this one in particular, because I still think that the Bank of Japan is relatively trying to keep all the expectations in check on whatever rate hikes they may start to do. So inflation is one thing, and the rest of the data and comments are the other, right?
Yeah. Right, I've just seen the clock. Oh, we waffled on this morning, mate. Should we call it there? And I know you haven't had a look at the charts, but we can.
No, don't worry. So just to remind people, 88.20 dollar Swiss. I think 149.75, 150 on the dollar yen top side, 148.80 downside, 107.1525 euro dollar, 108.2530 top side, and we are in the middle of the ranges. And let's see what happens then over CPI.
And watch them 10 years at 420. Another kicker for the back. Right, okay, we need to hop. So thank you very much for joining us today. Cheers, Kate, as always. Trade safe today. We'll see you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.